Monetary policy. These are central bank activities directed towards influencing the quantity of money and credit in the economy. And we have two main subjects to this: money supply and interest rates. So how does this work? The central bank will reduce the amount of money in the economy, which means there's less for people to spend, and hence there's a reduction in demand and reduction in the rate of inflation. There is a chain effect. So basically, the whole point behind these policies is to effect on the rate on inflation. Let's talk about interest rates. To achieve the same result, the central bank will also need to increase interest rates so that borrowing becomes expensive. Hence, many people are discouraged to borrow, therefore less demand for goods, and reducing inflation to a lower rate. So there's a reduction in borrowing, reduction in spending, reduction in demand, and reduction in the rate of inflation. Another chain effect. So let's explain the interest part of the equation. You have a family to keep, you're right here, and you want to purchase something from the supermarket, but you don't have any money, you have exhausted all your funds. So what do? The only option you have right now is to borrow from your bank. So you go to the bank tells you our interest rates have increased to 5%. However, last time they were at 3%, which means there's an increase in interest rate. So from your own analysis, this may be too expensive for you, because if you borrow $800, it means your interest when you pay back will be $5. This example is only meant to simplify things. That's why we're using smaller amounts. So you borrow $100, it means you have to pay $105. But last time, if you had borrowed at 3%, if you borrow $100, you would have paid $103 back to the bank. Now that you have noticed that we are using 5%, what do? You analyze if you can pay that back or if that's too much for you. So one individual may say, that's too much for me, I don't need that amount of money, and I can't pay back that amount of money. So what do? They then retaliate and say, no, we are not purchasing anything and we are not borrowing anything. This means there has been a reduction in the level of demand, and also there has been less demand for money since people cannot afford to get the money. So this all basically is aimed at reducing the rate of inflation. By reducing demand or by discouraging customers to take out loans from banks, it then reduces demand in the economy. Reducing demand would then affect on inflation. It reduces inflation. Remember, the higher the demand, the higher the rate of inflation in the economy. However, we may have an opposite scenario to the one we just had. This time there's been a low rate of inflation in a country and the government wants to increase the rate of inflation. So what does it do? Not the government, the central bank. So the central bank will increase money supply and reduce interest rates. By increasing money supply, it's going to increase demand and then increase the rate of inflation. By decreasing interest rates, it's going to increase or encourage borrowing, increase spending, increase demand, and increase the rate of inflation. So one may ask, is it good to have inflation rising? Yes, it is. We have more to discuss in another video. So if you notice here, there's a chain effect. And to be sharp at this subject, you have to understand this chain effect. That's for you to understand the subject. It's not that tricky, is it? So let's look at the overall points. The monetary policy is by the central bank to influence demand and control inflation. These are the three main points that differentiate monetary policy from other policies like the fiscal policy, which will be explained in another video. So it can be used to influence demand to increase or to decrease. Demand can then later on influence inflation. Thank you for watching, and don't forget to like and subscribe.